The national portion of the life insurance exam frequently tests your understanding of the accidental death benefit rider, which is often called double indemnity in exam scenarios. This rider pays a supplementary benefit, typically equal to the face amount of the base policy if the insured dies as a result of an accident. A critical detail the exam will test is the 90-day rule. For the double indemnity to pay out, the death must usually occur within 90 days of the physical accident. If a person lingers in a coma for 4 months following a crash and then passes away, the insured typically only pays the base death benefit and not the additional accidental benefit. You must also distinguish between an accident and an illness for testing purposes. If a driver suffers a massive stroke that causes them to veer off the road and die in a collision, the examiner will likely argue the death was caused by a health condition and not the accident itself, meaning the rider would not trigger. Think of the mnemonic, sudden, sharp, and short, to remind you that the event must be a sudden external force. It must be the sharp or primary cause, and it must happen within a short 90-day window. Note that these riders also have an expiration date, usually at age 65, so look closely at the age of the insured in the test question. Exclusions for accidental death riders are another favorite for test riders. They will often list scenarios like death while committing a felony or death while piloting a private plane. These are standard exclusions that will prevent the rider from paying out. Even if the death was technically an accident, if it happens during an excluded activity, the insurer is not liable for the double indemnity portion. The long-term care rider is an increasingly popular topic on the national exam. This rider allows for an acceleration of the death benefit to pay for costs associated with nursing homes or home health care. The most common way the exam tests this is through the activities of daily living, or ADLs. There are 6 standard ADLs, including bathing, dressing, eating, transferring, toileting, and maintaining continence. The rule of thumb for the exam is that the insured must be unable to perform at least 2 of these 6 activities to trigger the benefit. If a question describes a person who can no longer drive or cook but can still perform all 6 ADLs, they do not qualify for the rider benefits because driving and cooking are considered instrumental activities and not basic ADLs. It is also vital to remember that the money paid out via this rider is not extra money like the accidental death benefit. Instead, it is a draw against the death benefit. If a $100,000 policy pays out $20,000 in LTC benefits, the final beneficiary will only receive $80,000 upon the insured's death. The cost of living rider is designed to protect the policyholder's purchasing power against the effects of inflation. This rider is almost always tied to the Consumer Price Index, or CPI. As the CPI increases, the face amount of the policy increases automatically. The exam will focus on the relationship between coverage and cost. When the coverage increases under a COLA rider, the premium also increases to account for the higher risk the insurer is taking on. However, a major advantage that the exam emphasizes is that the insured does not have to provide any evidence of insurability. They do not need to take a new medical exam or answer health questions to get that extra coverage. Use the phrase CPI for COLA to remember that the Consumer Price Index is the engine that drives the cost of living adjustment. A common trap is confusing this with the Guaranteed Insurability rider. While both allow for more coverage without a medical exam, the Guaranteed Insurability rider is triggered by specific ages or life events, like marriage, whereas the COLA rider is triggered automatically by economic inflation. If you remember these specific triggers and the 90-day rule for accidents, you will be well prepared for these rider questions on the national exam.